Howdy everybody, I'm Professor Martin and I want to welcome you to managerial accounting or maybe intermediate accounting or maybe business finance. We have a whole lot of different classes in the curriculum that cover the topic that we're talking about today, and that's financial statement analysis. Specifically, we're going to be looking at a thing called horizontal analysis. So I'm not sure what class you're taking, but I am sure that that class is going to contain the information that we're going to be looking at in our unit on financial statement analysis. So at this point in your life as a student, you probably already had financial accounting. And in financial accounting, you hopefully recall we spent a lot of time recording transactions and compiling them into financial statements. One of the financial statements we made was called the income statement. And you can see here we have Wal-Mart and their income statement. If you remember back to your financial accounting days, our income statement shows revenue minus expenses equals net income. And then we also made a balance sheet. And the balance sheet for Wal-Mart right here, you hopefully remember again, our balance sheet has that old accounting equation in it, doesn't it? Assets equal liabilities plus equity. All right. So we learned how to do that in financial accounting. We learned how to put together financial statements, and we learned a little bit about how to read them. So what's the next step? Financial statement analysis. What are we doing? Well, we're going beyond just a basic reading of the financial statements. And what do I mean by that? Basic reading, for instance. Here's our income statement for Wal-Mart. And if I show you that, you'll probably look at that and say, oh, well, I can tell that revenue went up. Total revenues went up. I can tell that net income went down a little bit. Well, okay, that's a basic reading. Anybody who knows how to read a number can pick up that financial statement and see that the numbers went up right there. Anybody who's had even a rudimentary knowledge of how to read a financial statement can look at that and say, okay, net income went down. It's pretty easy to tell numbers going up and down. That's not really reading and analyzing a financial statement. We want to go beyond that. We want to understand exactly how much things went up or down. We want to understand why things went up or down. And that's where financial statement analysis comes in. It goes beyond a basic reading of the financial statements, and it provides insight about the current and future performance of a company. And so I can take that financial statement and read it and have a really good understanding of where the company's been, but also start to be able to make some maybe educated guesses about where the company is going financially. And it's going to do that by looking at the trends and the relationships among the items on the financial statement. If we're just reading financial statements, we're just looking at that top line saying, okay, it went up. But we don't really have an understanding maybe of how that top line revenue and those expenses impact the bottom line net income. And so we're really going to get our hands dirty. We're really going to learn how to analyze those financial statements. And so we can see all the trends. We can see the relationships among the items on the financial statements. So we have two sets of techniques that we're going to be covering for you in our videos. We're going to talk about common size analysis. And I mentioned already we're looking at horizontal analysis in our video right now. We'll do another video where we look at a thing called vertical analysis. And then we'll talk about ratio analysis. We're going to have three different categories of ratio analysis that we'll look at in separate videos as well. So, common size analysis. What is it? In a common size analysis, we're going to take every line item or account in the financial statement. We're going to express it as a percentage. And we look at our financial statements, we can see everything's expressed as a dollar. All right, so we're going to try to take that information, instead of showing it as a dollar, we're going to show it as a percent. Now, why in the world would we want to do that? You think about who is Walmart's probably, I don't want to say biggest, but a main competitor of Walmart. You think about the different businesses that competed against Walmart. Maybe you're thinking of Amazon, Costco. Maybe you're thinking about Target. And so I've got the income statement for Walmart. I've got the income statement for Target, two direct competitors here. But if I want to try to compare dollars to dollars, you might have a hard time doing that. Look at the total revenue for Walmart. We're talking $611 billion with a B. All the amounts here in millions. So we're talking 611 billion. But when I look at Target's revenue is 109 billion. So even though they're in the same industry, Walmart is 6 times bigger than Target. And so if I'm just looking at a basic reading of the financial statements and I say, oh, well, look at Target, their revenue went up. Well, okay, Walmart's revenue went up too. And so I need a different tool to be able to kind of understand what's going on here and to be able to compare Walmart to Target, aside from just looking at the dollar amounts. So in a common sized analysis, I'm going to put things in the context of a percent instead of looking at a dollar. So horizontal analysis, it's exactly what it sounds like. Horizontal goes left to right. You can see my arrow right there. We're going left to right in the financial statements. So what that means is I'm looking at that income statement right here. I'm going to go left to right. I'm going to go year to year and look at the changes from year to year on that financial statement and then put them in a percentage format that's easy to understand and compare to other companies that may be of a different size. That's going to let me see trends over time. How much did my net sales go up from 21 to 22 to 22 to 23 or from 21 to 23? How much did my expenses go up year to year? How much did my net income go up or down year to year? And we're going to look at it as a percent instead of just a dollar amount. Every line item on the financial statements, on the income statement and the balance sheet, we're going to express it as a percentage of a base period. Now that base period could be the year before, or it could be some earlier period. And so what I mean by that is we could look at, the percentage difference from 2022 to 2023. We could look at 1 year. Or I could look at the entire span here. 2021 could be my base year, and I want to know how much revenues went up from 2021 to 2023, the newest year. Real simple math or real simple calculation to do that. You can see I've labeled our current year, year 3, the year before year 2, and the earliest year is going to be year 1. To calculate in a horizontal analysis a percent for any given line item, I'm going to take the dollar amount of that line item and divide it by the dollar amount in the base year. And then I'm going to multiply by 100 to get my percent. Easy as that. So let me kind of show you how this is going to work. Net sales right here at the top for Walmart. You can see we got 3 different numbers there. Our most recent year, and year 1 is going to be my base year. So percent for year 1. I'm dividing 555,233 by the exact same number and multiplying it by 100. Year 1 divided by itself is basically 100%, right? And so if we're just looking at year 1, there's no trend there. It just is kind of our base amount of 100%. But then we move to year 2. And that same idea, we're going to take 567,762 and divide it by our base year. Year 1, 555,233. And then we're going to multiply that by 100. When I do that, I get 102.3%. What that means is year 2 revenue is 102.3% of year 1. Or to kind of put it in other words, net sales or revenue increased by 2.3%. And kind of pull away that 100, we're left with 2.3%. All right, everybody kind of see what's going on there? We took year 2, divided it by our base year 1, multiplied by 100, we get 102.3%. Net sales went up by 2.3%. Let's look at year 3. We take 605,881 and we divide it by the base year, 555,233, multiply by 100, and we get 109.1%. Net sales went up 9.1% from year 1 to year 3. All right, easy as that. Real simple math here, and we can put it in a percentage and we can understand exactly how much our sales have gone up. Then we can compare to Target. Makes for a real easy comparison. All I've done here is I've just put that information in a table. You can see our year 1, sales were 100% of sales. Year 2, sales went up 2.3% from year 1. Year 3, sales went up 9.1% from year 1. And so, okay, well, what about the increase between years 2 and 3? Well, real simple to get that. We just take that 9.1, subtract 2.3%, and that would tell us exactly how much our sales went up from year 2 to year 3. Or conversely, we could have just divided that year 3 amount and used year 2 as our baseline. All right? So real simple math here, just trying to figure out percentages. One other thing I want to add to that. What about net income? It would kind of stand to reason if our sales had gone up 2.3% from year 1 to year 2, our net income should probably go about 2.3% too, correct? If our sales went up 9.1% from year 1 to year 3, we'd expect net income would also increase in a similar percent, right? Sales go up, our income should go up too. So let's take a look at that hypothesis here. We've got the exact same income statement. You can see down here at the bottom we have net income. Just offhand, I can tell that net income, in fact, did not go up in a manner similar to our net sales there. If we take percent year 1 net income, divide net income by itself, multiply by 100, again, our base year is 100%. Year 2 right here, 13,673 divided by our base year, 13,510, multiplied by 100, we see our net income went up 1.2% from year 1 to year 2. How about year 3? 11,680, we divide that by our base year, our net income actually went down. Instead of being more than 100%, we're at 86.5. So our net income actually went down 13.5% from year 1 to year 3. We can look at that in our table. After we've done the math here, we can see net income went up a little bit in year 2 and went down in year 3. So what's going on here? What in the world? How can our net sales go up 9.1% from year 1 to year 3, but our net income actually went down 13.5%? And so we're getting 13.5%. Well, 100 minus 86.5, 13.5%. Okay? So think about the income statement. Revenue minus expenses equals net income. Revenue goes up, net income goes down. What has to be going on? Well, our expenses must be going up quicker than our net sales or our revenues, right? So let's dig in a little bit here. I'm not going to go through and do all the math by hand. I'm going to use a spreadsheet because a spreadsheet is by far the quickest way to do it. Now I'm going to show you in a separate video how to get data from financial statements into an Excel spreadsheet so you can do the math real quick. But for now, I've already downloaded the information in a spreadsheet. I've made that available to you in the links underneath the lecture video. You can download and follow along. But what I've got is Wal-Mart's income statement rendered in an Excel spreadsheet. And we're going to try to get to the bottom of exactly where these expenses are going up, because we know our sales have gone up, but we know our net income has gone down. So where are we kind of missing the mark here on the expenses and having our expenses increase at a rate quicker than our sales are going up? And so I'm going to pull that spreadsheet up real quick, show you how to do the math in Excel here. Here we go. There's my spreadsheet right there. You see, I've got revenues, expenses, and I've got net income down here at the bottom. We're going to start on year 1. Real simple math here. I'm going to say equal, and then I'm going to divide by that exact same number. Now, you'll say, well, wait a second, I thought you said multiply by 100 to get the percent. Yeah, I'm going to let Excel do that for me by using the percent format, just like that. Okay, now I've got my 100% there. And I'm going to copy that formula down, all the way down my column here. Any errors where I've got a referencing a blank cell, I'll just delete that. Okay? So, you can see your base year is always going to be 100% of the base year. Let's move to year 2. Equal our number in D4 divided by our number in F4. Net sales in year 2 divided by net sales in year 1. Again, I'm going to adjust my formatting so I can get a percent, give it 1 decimal place. Our net sales have gone up 2.3% from year 1 to year 2. We already knew that, but let's go ahead and copy that down and delete out the error messages I get there. And then we'll do year 3. Year 3 divided by year 2. We're going to turn that into a percent. And then we're just going to copy down through here. So again, you can see my math right there, B4 divided by D4, all that good stuff. Actually, let's take that by the base year. Keep consistency here. Take that by the base year, and then we'll go down. There we go. So, to kind of reiterate what we learned when we did the math by hand, our sales have gone up 9.1% from our base year of year 1. Our net income, bottom line profit, has gone down 13.5%. When sales are growing, but net income is falling, that means our expenses are growing quicker than our sales. And so if we look, our main expense right here, cost of goods sold, we can see it's growing at a rate of 10.3% compared to the base year, whereas sales is growing at a rate of 9.1%. So our cost of goods sold is growing at more than 1% quicker than our sales is growing. Our selling general administrative expenses are growing a little bit quicker than our net sales as well. So that's our issue right there. We got these two big expenses that are growing at a rate faster than our sales and revenues are growing. And that's leading to us having a lower net income, 13.5% lower compared to the base year. And so if I'm looking at it from a managerial perspective, if I'm a manager here, what do we need to bring in line? We need to lower our operating, selling, general administrative expenses a little bit, and we need to lower our cost of sales, our cost of goods sold. And so that's the takeaway. I could not come to that conclusion, or it'd be very difficult to come to that conclusion if I was just looking at the financial statements, right? Let me go back to my financial statements here. Here's my financial statement, my income statement. If I'm just looking at the dollar amounts, I might look at the dollar amounts and say, oh, well, revenue went up. Everything's A-okay. But it's not, because my expenses are growing at a rate faster than what my sales are. We have an issue here. And so that's where common-sized analysis really helps us out. It helps us understand what's really going on beyond just trying to look at the dollar amounts. Now I want you to give it a try. We looked at Walmart. Why don't you take a look at Target? I've got the income statement right there. You can by hand calculate the percentages year to year, using 1 as the base year for net sales and net income. And then we can kind of compare Target to Walmart. And I'll pause the video, let you do a little bit of math, and see how you come out. All right, hopefully you've had a chance to pause and do a little math on your calculator there, your 10 key, whatever you're using. Here's what we come up with when we look at Target. You can see I've already done the math in Excel right there. I've plugged it in. Whereas Walmart had revenues increasing from year 1 to year 3. I think it was 9%. Look at Target. My goodness, went up 16.4% from year 1 to year 3. Really big jump. But look at net income. Net income went up 59% from year 1 to year 2, but look what happened between year 1 and year 3. Goodness gracious. Nearly a 40% drop in net income from year 1 to year 3. What in the world happened? How can sales go up 16% but net income go down 40%? Again, let's look for the culprit here in the data. Look at cost of goods sold. We went from our base year to year 3. 124.3% of that base year. So a 24.3% increase in cost of goods sold. Sales only went up 16.4%. Wow. So huge increase in cost of goods sold. So our takeaway here, Horizontal analysis looks at year-to-year trends. The math is easy to do. Whether you do it by hand or whether you do it in Excel, it's a real simple calculation. We're just dividing one number by another one. Maybe multiplying by 100 to get a percent if we're not doing it in Excel. Easy math, but really powerful insight. I can really start to understand what's going on in the financial statements by doing a common-sized analysis, using horizontal to go year to year and looking at the trends. And it's not just for the income statement. I did all these examples on the income statement, but we could pull up the balance sheet. We could pull up the balance sheet and do the exact same thing on the cash account. We could do the exact same thing on the inventory account, accounts payable, long-term debt, whatever account you wanted to. You're going to have a lot of opportunity to practice doing horizontal analysis in your homework, and we'll try to apply it to real-life scenarios and real-life businesses so you can maybe look at companies that you're familiar with. In our next video, we're going to take a look at vertical analysis. Instead of going side to side on the income statement and financial statements and looking at the trends, year to year, we're going to be looking up and down. We're going to be working up and down the financial statements on the income statement and the balance sheet. And then later on beyond that, we'll get into the ratio analysis. By the time it's all said and done, hopefully you have a really good handle on how to break down and analyze a financial statement. If you have any questions, I'd be happy to help. Feel free to reach out as you're working through your calculations, or if you find an interesting example in a company as you're looking at a financial statement, I'd be happy to discuss that with you. Reach out anytime. Until next time, take care.